A potential banking crisis has been averted for now after the US Federal Reserve stepped in to secure the money of all depositors of failed lender Silicon Valley Bank. Regulators shut down America's 16th largest bank on Friday after it announced a share sale to boost its bottom line, sparking a run on withdrawals. The SVB share price tanked more than 60% on Thursday before trade was halted, and a further 20% after that. It's the largest bank to fail since the GFC, with another bank, Signature, failing over the weekend. There are now fresh fears of contagion in the wider financial market, despite the Fed's move today. In a statement, the Federal Treasurer has said some Australian firms have been impacted, but any fallout for Australia's broader financial system is unlikely to be significant. ASX-listed companies reportedly caught up in the chain reaction include Pengana International, Airtasker, Nitro Software, Whisper, Life360 and SiteMinder. Matthew Tuttle, CEO of Tuttle Capital Management, blames management and authorities for the collapse.
Yeah, there are a couple of big reasons. I mean, number one, the people managing their assets completely and totally screwed up. And number two, the banking regulators totally missed what's going on because they were too worried about another 2008 and didn't take into account what happens when interest rates go up.
It's reported that SVB lost around $1.8 billion offloading assets, which mainly included US government bonds, which we know have tanked since the Fed started raising rates. So then, is the Fed partly to blame for this collapse due to its aggressive rate tightening policy?
To an extent, but really at the end of the day, I mean, we've been sitting here for over a decade with interest rates going down. And the Fed was pretty clear in November 2021 that, hey, inflation's a problem. We're going to start raising interest rates. To me, if I'm managing money for a bank, I don't manage it the same way when the Fed is raising than when the Fed is, when the Fed is accommodative.
So this is the largest bank failure since the GFC. What do you expect the fallout to be for both the tech sector, finance markets and global markets?
So, I think there's going to be a couple of things. Short term, it looks like, they're going to come in, tonight or tomorrow morning when our markets open and try to shore things up. Short term, that may be okay. But to me, this is a canary in the coal mine. If other banks are having these problems, which I'm sure they are, you could see runs on other smaller banks. I do not think we've seen the last of this, and this is going to reverberate all over the place.
Well, where are the other vulnerabilities or reverberations going to be? What other smaller banks have large government bond portfolios?
So, and it's not even that anymore. I think that if you're sitting with money at a smaller bank right now, you got to seriously consider moving it to one of the too big to fails. A JP Morgan, a Chase, a Wells Fargo. I think these regional banks are going to have some real issues, regardless of what the government does to try to backstop this.
So do you think there'll be a run on the smaller banks?
So I don't know that there'll necessarily be a technical run, but certainly depositors are going to look at it. And again, I think some are going to be moving to the larger banks. And, and I think there are other banks that are sitting on, a lot of treasury losses, pretty much name your regional bank and they're in somewhat of a similar situation.
Well, you mentioned depositors there, Matthew. Just how much money is at risk and whose money exactly is it? Who are SVB's clients?
So SVB was a little bit unique that they were so focused on the venture capital world. So you got a lot of these startup tech companies with all their money there. That's at risk. Payrolls are at risk. The whole venture capital system really is at risk here. And again, this is going to spread out all over the place.
Well, the Australian Treasurer doesn't expect the fallout to be significant here. What do you think?
So, I think anytime something happens in the U.S., the saying is when the U.S. catches a cold, the world sneezes. So I think if we've got an issue here, you're going to have an issue there. It's going to reverberate globally. And I think investors have to be prepared for that.
So what are some of the solutions the FDIC would have been looking at over the weekend?
Shoring up the uninsured deposits. There's talk right now that the Fed is going to open up their discount window to make it easier for banks to get money. Whether that means I can give them a security worth 80 and get 100, that's not clear. It's also very clear there's no appetite for a bailout here. I don't know how long that'll last. I mean, we've got a saying in the States that, when a deer wakes up in the morning and it wants to survive, it doesn't have to outrun the lion. It just has to outrun the slowest deer. And I think when you're a bank, you can have an issue as long as you're not the first one to go under, you might still get a bailout.
And what do you think the best outcome for the bank customers and the broader financial system would be?
So I think the best outcome is uninsured deposits, get backstop. I mean, the equity has to go to zero. I mean, you can't prop those guys up. The executives made this happen have to get fired. I mean, there's so much moral hazard here if that stuff doesn't happen. But, I'd hate to see all those depositors get wiped out. They didn't think they were taking risk. If I buy the stock, I know I'm taking risk. If I'm putting money in, I mean, that's going to be a big problem.
Matthew Tuttle, thank you.
Oh, thanks for having me.
Well, after speaking with Mr. Tuttle, the US Federal Reserve announced its decision to protect all depositors, insured or otherwise. For analysis on this development, I was joined by Forager's Steve Johnson. Steve, is this move from the Fed the right one?
I think it is the right move. It is a bailout of deposit holders, but equity holders are going to lose 100% of their money here, and unsecured lenders to the bank are also going to lose significant amounts of money. I just think in a first world modern economy where you are putting your money in a regulated bank, you should be able to expect that you can get that money back out, even if you are a corporate depositing millions of dollars in some cases. I think a well-functioning economy needs a banking system where people can trust it.
OK, SVB booked a huge loss after selling those US treasuries, which should have been as safe as houses, really, when you look at that investment, because you hold them to maturity, but these ones weren't. Bank of America has huge exposure to these HTM bonds. Just what sort of problem could these types of instruments be for the sector?
I think it's been a shock to almost everyone that this crisis could be so simple. They own all of these long-term assets on one side and they've got deposits that they need to pay back the next day on the other side. So when the price of those assets moves and someone wants their money back, you can't realise the value that you thought you had. I would be very, very surprised if Bank of America, being large, systemically important, much more heavily regulated, doesn't have protection on the other side of its balance sheet in the form of hedging. So I actually don't think it's as big an issue there, but I do think this whole era of low interest rates is causing risks to pop up all over the place, and we are going to see a lot more of that in places that people haven't yet thought of.
Have you thought of any of those places yet?
Yes, I think the commercial property sector is one where they are just refusing to accept that the interest rates that they were using to value their assets are higher. And I even think inside our superannuation system, there is a lot of carrying assets at the cost that people bought them at when the world has moved in terms of interest rates, and particularly their infrastructure assets, where the super funds are sitting there saying, well, we don't care what the market price is in listed world, we're carrying this at the price that we bought it at. I think there are potential risks there of those assets not being worth what they're being carried at by the super funds.
So need to look at valuations there. Just in terms of US interest rates, how does this change the Fed's trajectory? We saw Goldman Sachs have come out today saying they expect no rate hike in March. Now, is the pause now on?
Well, some people were saying it could have been a larger than anticipated increase just a week ago. So they were talking about 0.5% instead of 0.25%. I think the 0.25 now is the maximum. But I think with the magnitude of the bailout that we've seen here and the strength of the employment data and wages data that we saw last week, there is probably still a case for rising interest rates here and dealing with these banking industry issues the way that they are dealing with them right now.
Just on the implications for Australia, we know that a handful of ASX listed companies have reportedly been caught up in this. What do you expect the impact to be?
Well, they're all going to get all of their money back tomorrow now after the announcement from the Federal Reserve. So it's going to be very, very minimal. And I think more importantly, we have a banking sector here that I think is far more effectively regulated than what you see in the US. There's plenty of other things that could go wrong in our banking sector with its exposure to the housing market. But something as simple as this that has come about through a fault of regulation, I find it hard to imagine this type of thing happening here in Australia.
Steve Johnson, thank you.
Thanks a lot.